with interest rates falling, where should investors turn to get more bang for their buck? Join us this week as we talk about where to find yields for you in a low interest rate world on the next Label on Fire.
Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
Welcome to this episode of Label on Fire, and I'm with Label Sternbach. He is Amazon's best-selling author of Living with Financial Anxiety and also author of the book Authenticity. Label, welcome back, and it's so good to be with you.
Hey, how are you doing on this winter day?
Well, I am, and the next word could be cold, but we won't go there today. As I mentioned in the open, we have interest rates are falling. We've talked quite a bit in the past about what the government would do with lowering interest rates and adjusting that rate. I'm wondering, where should investors turn right now to get more out of their hard-earned dollar? And I'm wondering what we can do to maximize what's happening around us, those things that we can't manage. What can we latch onto right now that we can?
Those are great questions. So let's take them one piece at a time. Let's talk about interest rates.
Okay.
So when I was first becoming aware of finances and I was starting to plan my retirement, banks were offering 5-6% interest rate. And that was the norm. Like my entire childhood, that was the norm. You got 5-6%, right? And that was everyone's retirement plan. You put away your $500,000, $1 million, and then you put it in bank CDs and you earned your 5-6%, right? And maybe you went to the smaller banks or the credit unions and got an extra percent or two. And you lived off of the interest from your bank CDs. And that was, for many retirees for a very long time, that was a very viable strategy. And then what happened? 9/11, right? 9/11 comes along, and in order to stimulate the economy, we go on a war footing and we drop interest rates basically down to 0%. And overnight, the retirement strategy for so many people just disappeared. And for most of the last 25 years, interest rates have been really low, right? Historically low. Over the last few years, they've recovered, but it's coming back down. And the world wants interest rates to be low. Silicon Valley wants interest rates to be low. When interest rates are low, it's basically free to borrow money, invest it in other things, and those other things pay out a whole lot more than what you would get in terms of interest. So it's a net benefit to everyone all around, except for us that want our money to be secured and want a consistent paycheck off of that money without having to take risk. So the question becomes, okay, where do we get, right, as interest rates fall, as we go back to more the recent historical average of somewhere between 0 and 2-3% interest rates? What do we do? Where do we look for to get some of that yield, right, without having to take on risk? And I want to, before I go into kind of the specifics, I do want to kind of put this in the context of that we have one large investment banking apps there, and now they're coming out with their projections for the equity markets over the next 10 years. And a lot of them are projecting that the average return over the next 10 years is going to be 3 or 4%. And they're projecting this for a number of reasons, but the biggest one is that right now the market is really heated up, right? We have valuations in the United States that we haven't seen since almost the dot-com bubble, where companies are at, 20, 30, 40 times multiple of their earnings. That means that investor would have to, the company, in order to return capital to the investors, would have to make the same amount of money that they're making today for the next 30 to 40 years, which is an insane amount of time, right? Nobody thinks that the world is going to be the same in 20 years from now, let alone 40 years from now. And
that's a long view.
Right. It's a very long view, and it's unrealistic. So the question is, right, do those prices have to come down, right? Are they going to come down, or is growth going to slow, or are companies going to fail and other companies are going to come into existence? And there's a lot of betting that's what's going to happen because of AI, because something that we've talked a lot about on the show about onshoring, where we're bringing back chip manufacturing from overseas. We're bringing back the critical national security interest industries back to the United States. We also have Trump and the rhetoric that he has of tariffs and controlling China. And how exactly that plays out is anyone's guess, right? We know what the administration wants to have happen. They want to bring manufacturing back home, but is that actually what ends up happening? Who knows, right? We can end up in an extended trade war, and that wouldn't be good for anyone. So anyways, long story short, right? The question is, where do we get yield without getting risk? And you can't just turn to the equity markets and say, well, I'm going to go invest in equities and I'll do a 60-40 portfolio, right? Which that's the traditional solution is, okay, as interest rates fall, we take on more exposure on the equity markets because that's where we'll get our yield. And there's kind of this dichotomy that exists in there. So as savvy investors who are afraid of the future, because we've been through 2000, we've been through when everyone thought the internet was the big greatest thing, but it took 20 years to realize the greatness of the internet, right? Amazon started in, I think it was 2003, which was at the end of the dot-com bubble. And they took advantage of what everyone was hyping of the 90s. But even Amazon didn't show profitability until the late 2010s, right? We're talking about sometime in the last. So having said that, what do we do as investors? And really there's only a few answers to that question. But the simple version of it is what we need to do is we need to take on the least amount of risk possible to get the greatest return. Right. And so when we look at the last few years, the least amount of risk was we give it to the federal government. We buy treasuries. We get, 5-6% return on our investment over there. Right. No risk. Right. If the United States starts failing to pay on its debts, well, the world economy has really got bigger problems. But then you got to ask yourself the question, okay, as those rates come down, what's the next best thing? Right. Next best thing is government agencies. Right. So government agencies, they're not quite backed by the taxing power of the United States government, so they have to pay a little bit greater return. But at the end of the day, it's the United States government agency, right? Like they're the FEMA, these big government agencies that have to do big capital works, they put out bonds. We can buy those bonds. It pays an extra 1 or 2%. Then you have, you start going down the table of, taking on more and more risk. And you have huge companies like IBM is probably not going anywhere, right? They've been around for over 100 years. They're probably going to be around for another 100 years, not because they do anything amazing, but because they've embedded themselves in so many facets of life that it's just impossible to remove them, right? Same thing with Microsoft, right? Microsoft, I think I saw a stat. It was something like 70% of government computers run Microsoft, right? The government can't afford for Microsoft to stop functioning. Same thing with Google, right? Google, you can buy bonds from Google. You can buy bonds from Microsoft. You can buy bonds from these major companies, Ford, right? And they have to pay greater interest rate because they are not the federal government. But the risk of them defaulting is still pretty minimal, right? They're going to be around for the long haul. And if we can stick it out, we're going to get that money. And especially if they're giving us a bond that's, a year, 2 years, it's not a huge long-term thing, right? Mm-hmm. And so what I'm getting at is what we need to do is slowly ratchet up that risk that we're taking on, but we need to do it in a very controlled way so that we're not taking on more risk than we need to, right? So right now, interest rates are, somewhere about 4.5%, depending on where you're going. Right, it's probably going to come down to closer to the 3.75, after this next Fed meeting. But what that means is, okay, our base can still be, let's say 60% can still be federal treasuries, but we need to start giving 10% more to a little bit more yield, 10% here to a little bit more aggressive, so that even if something catastrophic happened with those, we're only looking at a few percent loss. But in exchange for that risk, we're getting so much more, and we're getting back to that 6-7% return that we really need in order to have that sustainable lifestyle and retirement with minimal risk. And
so an advisor like you would help manage between those buckets of private sector, government agencies, the Fed, or the Treasury?
Yeah, that is one of our full-time jobs, is managing that. And managing that risk, right, so that it kind of dials in to what the expectation for the future is. Something that I want to point out, we're going through the process of launching some ETFs that do similar type strategies. And in the process of going through that, right, like I had a vague idea as a financial advisor. I knew that there were restrictions on what mutual funds and ETFs could do. So when you think about Vanguard and BlackRock, right, and iShares, they all have these target date funds and they all have these like retirement portfolios. And you're like, well, I'll just go put my money in them. And I was the same way. I was like, well, I'll just go get something off the shelf. And then I started looking at it, and something that we noticed over the last few years was everyone knew interest rates were going to go up, which meant that you wanted to sell certain things and you wanted to buy other things. And then as interest rates were coming down, right, the same thing, there are moves that you want to make ahead of that because you know it's going to happen. That as interest rates come down, the price of bonds are going to go up and vice versa. So take advantage of it, right? But these mutual funds and these ETFs did not. And the reason is that they can't. Because when they file their prospectus with the SEC and they say, this is what our investment policy is, this is how we're investing it, they're stuck with that, right? It takes a lot of money and a lot of effort for them to change that. And they're not going to do that, right? They're not going to risk the billions of dollars that they have sitting in these mutual funds that they're collecting fees on for doing what's right by the investor, right? They're just going to let it sit, let it ride. And if people want to move, they'll launch a new product, which Vanguard just announced that they're launching a product very similar to what we're doing because they're like, free money is ending. Well, great. Why didn't you do this 2 years ago?
So it's interesting. So as the transition happens between the existing presidential administration and the new one coming in, investors can take a bit of a sigh of relief and say, okay, we're okay because we've got a number of different strategies, a number of different buckets that will help us to take advantage of the interest rates no matter what happens.
Yeah. And more importantly, it's about gradually ratcheting up that risk as the market dictates us. As our opportunities diminish, right? Our opportunities for risk-free return diminish. We need to be smart about taking on the risk that we want to take on so that we're taking on the minimal amount and then allocating that across time, right? So that the money that you need for the next few years that you're going to live off on is minimal risk. Right, the money that you're going to have in 3 or 4 years from now that you can replenish that you take on a little bit more risk, which protects your long-term money, right, so that it can grow and get that full market return that we all know and love.
We've covered a lot of ground today, Label, but I know there's a lot more. Where can our listeners and viewers get more information about falling interest rates and how we can leverage ourselves as smart investors?
Yieldsforyou.com is always your best resource. We then have a whole bunch of calculators and articles on there. And always feel free to book a call with us. More than happy to talk with you, look over your portfolio, give you our 2 cents.
All right. Thank you, Label. I'm Freddie Bell. We got to leave it right there. This is Label on Fire. Join us the next time when we talk about the new tech bubble on the next Label on Fire. Bye now.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.